Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip looks at US Treasury supply, which is being absorbed by risk-averse investors. On Wednesday, the US Treasury successfully auctioned a record $32 billion in 2-year notes. Today, the US Treasury will auction a record $22 billion in new 5-year notes. The yield on the 5-year is at the low end of its recent trading range. Since May 7th, the range has been 2.90% to 3.76%. Low yields are a sign of a flight to quality, but Fannie and Freddie have been able to sell their debt necessary to support their mortgage-related activities and conduct new business at a profit. A week ago Wednesday, I was asked on Fox Business Countdown to the Closing Bell whether or not Fannie and Freddie needed an immediate bailout, which was rumored that day. I said no. The housing bill designed to help Fannie and Freddie does not become law until October 1st, and the pair will need to refinance $225 billion in maturity debt the day before. If that becomes a problem, U.S. Treasury help is on the way through the housing bill. My second blip tells you that despite lower yields and with Fannie and Freddie successfully on life support for now, the housing and banking industries are not out of the woods. Since bottoming on July 15th, the various housing and banking indices have formed trading ranges. No one knows whether or not this ninth bottom set on July 15th is the charm, but the charts since May 7th are now positive. The residential housing index, HGX, is trading between its 50-day simple moving average at 114.03 and its 200-day at 132.11. The Americas Community Banking Index, symbol AMAQ, is trading between its 50-day simple moving average at 193.67 and its 200-day at 219.66. The Regional Banking Index, BKX, is also trading between its 50-day at 62.26 and the 200-day at 78.62. My third blip answers a viewer question. Where can a list of problem banks be found? The answer is nowhere. The FDIC does not publish the actual list of problem banks. The list is 117 banks on June 30, but is said to be closer to 140 today. The viewer followed up asking, what does trouble mean? If my banks are on the list, are these banks going to just lock their doors? The answer is no. Typically, a failed bank is closed on a Friday, and assets are available on Monday at a nearby bank. Deposits of $100,000 and below are covered by FDIC insurance. If a bank is publicly traded in Foals, and you are a shareholder, the stock will likely be worthless. My fourth blip gives you the layman's definition of notional amount of derivative contracts. Jeff T. asks, what exactly is notional amount of derivative contracts? The number reported, 183 trillion, is the largest number I have ever seen reported on anything. Well, Jeff, what Wall Street investment banks have done is slice and dice mortgages and other securities into cash flow pieces which are repackaged and sold as swap transactions, which I call alphabet soup. The sum of the parts, all principal and interest payments, etc., add up to the notional amount of derivative contracts. Most of the surprise write-downs from Wall Street come from these huge risk pools. As I have said before, Wall Street and the regulators can't put Humpty Dumpty back together again, and Humpty is climbing a fragile wall of worry. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.